Guys, remember, we sell puts. Selling puts means if the company's currently at $50 a share, let's just say Paychex, $87 a share. I want to buy it at 55. What I'm going to do is I'm going to sell a put option, which gives somebody the right to put the shares in my hands if by the strike date, the date we pick, it falls below this number. So right now, what do you have right now? What's the June whatever?
Oh, you want prices?
Is there a better word for put that we can all understand what the hell this is?
Well, it's called a put.
I know what it's called, but is there a better word that you can think about?
Yes,
how can
put it in my hands. How is that not easy?
Because
somebody's paying you.
In general, I think is you don't own it yet, or you do own it.
Hence, somebody's going to put it in your hands.
Okay, so you don't own the stock quite yet.
You do not own the stock yet. You're selling somebody the right to put the shares in your hands. That's why it's called a put.
And you're doing this because you want this company at
I want
this
company at
price.
55. What's the premium on this one?
So we're going to go $60. 55 doesn't have anything.
Okay, for what date?
June 18th, 148 days from now, 60 cents.
Okay. So somebody's going to pay me 60 cents, or basically 1% of the value, so that 5 months from now, they can force me to buy the shares if it falls below 60. So let's say it drops to 55. I still have to pay them 60 for the shares. I keep the 60 cents, and I get it for 55 bucks.
So for example, let me go back here. So for example, say the stock starts going down from 87 and maybe it hits 70. Then something terrible happens over the weekend. The market opens and this stock opens $5 less than your strike price. You're now losing your money and you have to buy this.
On the date right here?
Yes.
On that date right here, essentially you're forced to buy it at $60 even when it went below.
Okay.
But the theory behind this, the reason I'm okay with it is I was buying at 60 anyhow. So when I buy it at 60 anyhow, it was going to end up at 55. I lost $5 anyhow. At least here, I got 60 cents along the way to wait.
This is all right. This is really spicy, Paul. The comments are flying in. This is wonderful. Listen to this one. Owen says, Paul is selling the idea to get someone to make him buy the stock at 60. That's an interesting concept.
Yeah. So I'm sitting there saying, listen, do you want me to buy the stock at 60 from you, for you, from you essentially, from the market? If the answer is yes, great, pay me 60 cents and I'll do it.
I see. So this is the wager you're making, Trader Mo.
So let me give an example of what we're essentially doing is being paid to wait. Now, Phoenix, one of our patrons, he's doing something right now with Hanes brand HBI. It's $15.64 a share. He sold puts today expiring tomorrow at $15.50. So his goal is to be, if he gets assigned those shares at $15.50 or lower,
yes,
he's still being paid to buy those shares effectively.
So he's making money.
What are they paying him? What's the premium?
Let me find it for you.
So guys, the company's currently at $15.64. Because this thing expires tomorrow, it's going to pay him. He's picking a very low strike, a very close to the current money price, $15.50 for 1 day. For 1 day of waiting, he's being paid.
Mo,
$15.50, 10 cents.
10 cents.
Times 100 shares.
Don't worry about that. It's per share right now.
Okay.
10 cents.
10 cents per share.
So somebody's paying him 10 cents for 1 day of waiting. If this thing ends up at $15.50 or below, he'll be forced to buy it. But here's the good news. He keeps the 10 cents either way.
Either way.
If it closes here, he keeps the 10 cents, nothing happens.
And right now there's a 40% chance that that's going to happen.
Right now it's a 40% chance that what?
That it's going to be, the delta's at 15.50 is 40.
So the chance right now, the market's saying it's 40% chance it falls below this by the end of tomorrow.
Correct.
He's going to wait 1 day and get 10 cents. Now me, I like to go a month out or more because I want to bet on much lower prices. But if you want to own the shares like Phoenix clearly does, you write this very close because you're just going to collect your premium and it's free money. If you're going to buy it anyhow, just take the money.
Tony really says it best here. I sell put options every week. It's a great way to make an income while we wait to buy a stock we want at a discount.
Exactly.
I think I've said the same thing.
And Phoenix is doing this every week. He's building a position. So next week he's going to go out to next Friday and do
Guys,
the same
it has
thing.
become a very, very lucrative thing for me to do. When everybody asks me for my portfolio and look at my returns, this is going to blow everything out of the water.
I would say the same thing, Paul. You own maybe 30 stocks, but the list of puts you're doing.
No, I own like 12 stocks. I have like 50 positions of puts.
Yeah, it's all over. It's like 4 pages of
and
puts.
And when I own 100%, when all my money is invested in 30 stocks, I'm going to own hundreds of options because I'm going to sell call options, put options. I will outperform the market. If I just match the market in my stocks, my puts and calls will far exceed the market. But what's the catch?
Yeah,
One contract.
Yes.
Well, there's a couple catches. One contract equals 100 shares.
I think people are getting that in the comments.
Good. So a company like AutoZone, which we did a video of, AutoZone, AZO, each share is $12.50. So each contract is $125,000 worth.
That's a lot for normal people.
That's the problem.
Yeah.
That's now on HBI, it's $15 a share, so a contract's $1,500. $15, so it's $1,500, much easier. But I'm working in much larger share amounts, so I can sell a lot more and do a lot more because of that. It's an example of.
So I think you wanted to. I'm sorry, I didn't mean to cut
No,
you.
go. It's just, guys, that's why I'm apprehensive to show my holdings, because you guys can look at my stocks and say, oh, cool. All I have to do, I know I'm going to beat the market in my stocks over long periods of time, maybe not year to year, but the puts and calls are going to put me way over the edge. Like, I truly believe I'm going to make 15 to 20% returns a year over 10-year periods of time.
Yeah, after the numbers we did this week, that's
Like
very
the
feasible.
income is
Very
insane. Like
feasible.
I just did this month. I'm not going to say the number I made this month, but it was insane how much I made.
I mean, on the
options.
last year when you were on this podcast saying you make hundreds of thousands of extra dollars a year moving these
Yeah, it's
stuff
more than
around.
that.
Yeah,
Well more
it
than
is.
that.
Yeah,
It's
it's
well
more
more than
than
that.
Wow.
It's multiple seven figures.
So I bought more Biogen today. We did a Biogen video, guys, a couple days ago. We love Biogen. Currently, you have it priced almost you have it priced almost double what its current market cap is. But I have 40 shares of Biogen. You asked me, why don't we do options on
And I
this
just
thing?
said, here you go. I have 40 shares. I'm like, oh yeah.
Yeah, so I need more, but regardless, this is interesting, and we should certainly do more of this because the comments are flying in. People are very interested in this, and this is really, I think this is really upper level investing, Paul. I mean, just the idea. Most people are pretty lost just in general on how to invest.
So a friend of ours named Gary, when I first told him that I want to do this back in May, he said, go for 15. You can get 15% annualized returns. We don't necessarily always do that. We're just trying to get. We're trying to get enough income where it adds good return to our money without. We don't want to get the shares all the time placed to us, or what's called a covered call, which is you own the shares. Let's say you own. The other option to do is, let's say you own 100 shares of HBI. You sell one contract at, let's say it's at I think $16 in a month. And actually, Mo, just give me the example. What is the February 19th $17 HBI?
Well, we were looking at paychecks. Do you want to continue that? Because we went from 84 to 60. I mean, are you done with that, or did I cut you off?
No, you're probably. But let's do the one that's Phoenix because it's smaller numbers.
Okay.
February 19th.
Yep.
For what price?
17.
17. A covered call.
Yeah, covered call.
Say 30 cents.
Okay, so guys, right now Phoenix has HBI 100 shares at $15.64. You can sell somebody the right. This is called a covered call. You own the shares of HBI.
I have them in my account, 100 shares of this.
You have them. That's why it's covered. The bank doesn't consider this risky. You're selling somebody the right at $17 on February 19th to force you to give them the shares at $17. And they're going to pay you 30 cents. So what that means is if the stock ends up above $17, you got to give it to them for 17. So if it goes to 19, you lost out on $2. But you kept your 30 cents, so you really lost $1.70. But if it stays below 17, let's say it ends up at $16.99, you keep the shares and you keep your 30 cents. It's a way of generating income. What's the delta on that?
27%.
So what that says is the delta is 0.27. They're sitting there saying it's a 27% chance that between now and February 19th that HBI ends up above $17. That's another way I'm generating income. I'm selling puts and I'm selling covered calls on stocks I already own. I do not buy puts and I do not buy calls. I very rarely do that.
Very rarely.
I'm sitting here trying to say, give me the money for me to wait and give me the money to give you my shares that hit a certain price.